Today we're looking at a piece on Webull's Q3 results, a quarter that saw a 55% revenue explosion and a massive shift towards real profitability.
Right. And that shift is, it's the whole story. But to really sell this narrative, the piece has to connect the dots. It needs to explicitly link those catalysts, the AI and the global expansion, directly to that amazing new operating margin.
It's about proving the durability, right?
Exactly. It's about proving this isn't just a flash in the pan.
Because the numbers, they're just jaw-dropping. You're looking at a company that went from losing, $33.5 million?
A year ago, yeah.
To making almost $22 million in net income. That's a 23% operating margin. The material lays out the what, the numbers, and the why, Vega AI, global growth, but the weakness is they feel like two separate lists.
That's it, exactly. They feel disconnected. The piece does a great job celebrating the revenue number, that $156.9 million. Huge. But if your audience is a serious investor, you have to answer the big question. How do we know this 23% margin is here to stay?
So the suggestion is to synthesize the analysis.
Yes. You have to treat these catalysts not just as things that get you more users, but as actual structural changes that save costs or improve the quality of your revenue. That's what supports the margin.
Okay, so let's make that concrete. The Vega AI tool. The piece positions it as a cool tech feature. But how do we tie that to the bottom line?
Well, you have to frame Vega as an efficiency engine. The material should argue that this AI tool, the one for learning and analysis, is specifically designed to make users stick around longer.
Higher retention, yeah.
Right. But at the same time, it's driving down the cost to serve each user.
Ah, okay. That's the critical link. So as the user base grows, you don't need to hire a proportional number of expensive support staff because the AI is doing a lot of the heavy lifting?
Precisely. It becomes a non-linear cost reduction. You're moving the story from, we have a neat AI feature, to our AI is a core part of our long-term margin expansion strategy.
And we need to do the same thing for the global expansion part.
We do. We have to show how that strategy is what I'd call margin accretive. How it's actually helping profitability, not just growing the top line.
The piece does mention that partnership in South Korea with Meritz Financial Group.
Perfect example. You have to use that, highlight it as a case study in disciplined growth. This partnership model is a much lower CapEx way to enter a new market than, building a whole subsidiary from scratch.
Boots on the ground, all of that.
All of that. This single example shows that management is thinking about disciplined scaling. It proves they're serious about protecting that 23% margin.
But just to play devil's advocate for a second, doesn't a partnership model like that, with Meritz, potentially limit Webull's upside in the long run compared to owning the whole operation?
That's a fantastic point, and a sophisticated analysis should absolutely touch on that. And the answer is yes, on paper it might. But in the short to medium term, for a company that is laser-focused on proving its new profitability is real.
It's the right move.
It's absolutely the right move. It cuts your initial cash burn, it lowers your regulatory risk, and it gets you to market way faster. It signals that management's priority right now is margin control and smart capital deployment. It validates the whole pivot.
Got it. So framing it that way changes the story from just a list of new countries to a proof of a fiscally sound strategy.
Exactly. It shows the management team is thinking like operators, not just marketers. So let's switch gears to the competitive landscape.
Okay.
The analysis needs to be more proactive here. It should take that fierce competition risk and directly counter it by framing Webull's insane product velocity as its primary defense.
Yeah, right now the competition part is sort of walled off in its own bear case section. It's just a risk. But then elsewhere, the piece is celebrating all these new product launches.
And they are aggressive launches. Reintroducing crypto, adding corporate bonds, and then the really interesting one, these event-based prediction markets.
Which are clearly aimed at that super active high-value trader.
Without a doubt. So by separating the risk from the company's direct response, it makes the risk feel, more threatening than it is. It makes it feel like something that's happening to Webull, not something they're actively fighting.
It's a huge missed opportunity to show them on the offensive.
Totally agree. The suggestion here is to completely reposition that product velocity discussion. It's not just a list of new features. It's Webull's #1 competitive weapon. It turns the fear of competition into proof of their agility.
So let's take an example. Those event-based prediction markets. How would you frame that?
I'd argue that Webull is jumping on these niche, high-engagement trends. You know, the stuff you see on platforms like Callshe or Polymarket, faster than Robinhood or any of the big guys.
I see. So it's a defensive move to keep their active traders from leaving for those smaller, specialized platforms.
It's a preemptive strike. It shows their development cycle is just faster. It's not just about having more features. It's about having the right features right now. It makes the platform stickier for its most valuable users.
That's a much more powerful argument. And then you can layer on top of that the customer asset growth.
Oh, absolutely. That number's the knockout punch.
The 84% year-over-year growth to over $21 billion in assets? It's just a staggering number.
It is. And you have to use that as the ultimate proof that, look, whatever the competition is doing, Webull is winning the battle for the customer's wallet. This isn't just play money accounts anymore. People are consolidating their wealth there.
So you completely reframe the narrative. It's not competition is a risk. It's Webull is winning the competitive battle, and here's the proof. Their product is better and faster, and the money is flowing in.
That's it. You connect the strategic why, the product speed, to the financial what, the asset growth. It becomes a much stronger bull case.
Okay, that makes sense. So for the final point, let's talk valuation. To make those big analyst price targets, $15, $18, feel achievable, that 8.3 times sales number needs more context.
It really does. For the kind of reader this is targeting, that's the missing piece of the puzzle. The material says it's attractive compared to high-growth peers, which, I mean, okay, it's true, but it's too vague.
It's not actionable.
It's not. An investor needs concrete benchmarks to really buy into a 60 or 90% upside. You can't just say it's attractive. You have to show them the math.
So we need to introduce a specific peer group, give them a real range to compare it against.
You have to quantify the discount. Give the reader the context. Say something like, look, high-growth fintechs, names like X, Y, and Z, they typically trade in a range of, say, 10 to 14 times forward sales.
And right away, the reader can see that 8.3x is well below that average. It makes the attractive claim tangible. They can immediately see the potential upside just from a valuation perspective.
Exactly. It grounds the whole thesis in real data. And then you can take it a step further. I'd structure the argument around the growth delta. I mean, Webull is growing at 55%. That's the real story.
So you're saying you should find a peer that's trading at a higher multiple but actually growing slower than Webull is?
Precisely. That's the killer argument. You say, look at company X. They're trading at 12 times sales, but their growth is only 30%. With Webull, you're getting almost double the growth for a much lower multiple.
It highlights the value proposition perfectly. It moves the discussion from this stock seems cheap to this stock is mathematically mispriced relative to its growth. That's the kind of insight that gives an investor real conviction.
And it provides a clear, logical path to those higher analyst targets. It's not just wishful thinking. Right. And when you put all these pieces together, the whole narrative becomes so much stronger. The 55% revenue explosion isn't just a number. It's the result of a durable, defensible, and frankly undervalued strategy.
Okay, so to sum it all up, we've got 3 key areas for improvement on this Webull analysis. First, really tighten the link between the catalyst, the AI, and the global strategy, and the sustainability of that 23% margin. Frame them as structural cost savers.
Second, completely reframe the competition argument. Use the incredible product velocity and that 84% customer asset growth as your primary evidence that Webull is not just defending its turf, it's actively winning.
And finally, ground that 8.3x sales valuation in reality. Give specific peer comparisons to quantify the discount and provide a clear, data-driven rationale for why those high analyst price targets are justified.
That's it. You make those changes. You connect efficiency to the margin, you turn risk into a strength, and you quantify the valuation. And this analysis goes from good to truly compelling. We'd love to see the revised piece when you're ready.
Until next time.